Good afternoon, Mr. Gopal Krishnan, Mr. Padmanabhan, organizers of the Global Fintech Festival, delegates from both India and abroad, ladies and gentlemen. It actually felt good being introduced by Mr. Padmanabhan, although I must confess that you probably heard those things better than I did on the stage. Mainly for the reason that he is the kind of person, probably one of maybe 2 or 3 people in the Reserve Bank, that people like me looked up to as we progressed in our career. He was the person we had to emulate. There's the standard set by people like Mr. Padmanabhan were the ones that we had to emulate. He's right. We didn't really work together for a long time in one department, but we were pretty much in close contact virtually throughout our careers. In fact, when I joined the Reserve Bank of India, which was in Trivandrum, Mr. Padmanabhan was posted in Trivandrum, but he had just left around that time. So feels great, and with all familiar faces from the industry. These days, it looks like I have to speak on fintech or startups or payment systems so often that I find it difficult to get a new topic to speak on. Hopefully, I'll try and not bore you much, in this talk. To start off the formal speech, I'm delighted to be present in the 4th edition of the Global Fintech Festival, a platform which provides space for a meaningful interaction and sharing of ideas among stakeholders of the fintech ecosystem. The deliberations help all participants in identifying common objectives and provide inputs for potential policy actions. The elements of the theme of this year's festival, inclusion, resilience, and sustainability, succinctly captures the attributes of the sort of fintech ecosystem that one would like to see in India. The role of innovation in increasing the productive capacity of the economy is well understood. But where does innovation itself come from? Economists, following the tradition of Joseph Schumpeter, conclude that innovations are overwhelmingly the fruits of long-term investments that build on each other. Innovations rarely occur in isolation. It is by its very nature deeply cumulative. Innovation today is often the result of some pre-existing ideas. Innovation is also collective, with long lead times. What might appear as a radical discovery today is actually the fruit of years of hard work by different researchers. In the Indian context, the theory certainly holds true. For example, UPI, which now clocks more than 340 million transactions a day, is the outcome of cumulative efforts and investment in institutions and technologies by the Reserve Bank of India and the government over the past decade and a half. UPI also owes to private innovations, the private sector participants that have actually taken it, taken it in bridging the last mile and acquiring the kind of customer base that it has today. India's fintech players and the traditional financial institutions have all seized the opportunities offered by these public sector initiatives and created the thriving ecosystem that we see today. If I can divulge, sort of slightly, the typical model that we have in India, which is not really, appreciated in its entirety for the development of digitization in general, is the fact that basic infrastructure has been built in the public sector. Now, basic infrastructure building for a private sector is not generally seen, not just in payment system, but in any aspect of economy because of the long gestation periods and the huge investments required. These basic infrastructures built in the public sector are then kept open to the innovative and creative fintech and startup ecosystem that we have, who create products, who innovate products that meet the requirements that are the call of the day at that point in time. This structure that we have, that the infrastructure is created in the public sector and the private sector is given a free hand to innovate on it, is probably, probably unique to India. Now, to be sure, innovation in the finance space is not a recent phenomenon. Wire transfers or ATMs are also instances of technological innovation, as are modern stock exchanges with their anonymous order matching systems or algorithmic trading. Mr. Padmanabhan referred to the NDS home system that was introduced in 2005 in India. This is a stock exchange-like anonymous order matching system for bond markets. At the time that it was introduced, it was unique. No other major market actually had an anonymous order matching system for doing bond trades, for doing wholesale bond trades. In fact, I think to this day, there is no other major market where you have price discovery in the anonymous mode in the government bond market. In that sense, the NDS home system that we have had is probably one of the first few instances of a major fintech innovation. All these changes, whether it's stock exchanges or ATMs, for example, was a fintech innovation, we can call that. But all these changes were gradual and enabled the financial system to adapt to the new technologies in a by and large non-disruptive manner. What is different about the recent innovations is the speed and the scope of such changes, making them potentially far more disruptive. So much so that they merited the status of a separate industry and a new name, Fintech. It would be useful to remember that, apart from the difference in speed and scope, neither the older innovations nor the current Fintech innovations change the basic nature and functions of the financial system. The major transformation that characterizes the Fintech ecosystem is the increased efficiency with which financial products and services are delivered and consumed. This efficiency is driven largely by three factors. A, digitization of information, which can then be accessed, processed, and transmitted with ease. B, more direct interface between buyers and sellers, between borrowers and lenders, and between payers and receivers, which optimizes transaction chains. And C, democratization of fast communication channels that expands the reach of the financial system. Put together, these efficiencies lead to lower cost, quicker transactions, and better inclusion. This is clearly a desirable outcome and one that should be actively encouraged and promoted, which is what the focus of policy making and regulation currently is. But innovative developments raise different issues, not necessarily undesirable in themselves, but which need to be addressed nonetheless. One issue is the relative roles of traditional financial institutions, especially banks, vis-à-vis the fintech entities. Should their interaction be driven by motives of collaboration or competition? The second issue is what should be the approach of financial regulators. How is fintech ideally regulated? Same as traditional finance or differently? I shall try and talk about these two issues briefly in what follows. Traditional financial players, let's just call them banks for simplicity, have come to acknowledge the impact of fintechs on their functional roles, and they are reacting in one of two ways. The first way is by internalizing innovations, thereby placing themselves in competition with fintech entities. The second way is by collaborating with fintechs, either by engaging in one-on-one partnerships or by purchasing the services of fintech players. The latter kind of collaboration, purchasing the services, can also be functional, in the sense that fintech entities can perform functions where they have the competitive advantage and banks can focus on areas of their expertise. While customers benefit from an improved experience with curated products and services at competitive prices, regulators also draw comfort in these arrangements as traditional financial entities like banks, NBFCs, which are well regulated, and continue to discharge the primary responsibility of risk management through their own balance sheets. Perhaps the sweet spot lies in fintechs acting as both competitors as well as collaborators. The existence of competition is necessary to create incentives for fintechs to invest in innovations, as well as pushing traditional entities to stay on their toes. At the same time, collaboration is essential for innovation to be absorbed in the financial systems in as smooth a manner as possible. Traditional players with their robust balance sheets, capital base, and risk management practices can provide the strength and stability, while fintechs with their agility and innovative capabilities can deliver on customer experience, drive down costs, and expand access. What should be the area of collaboration and what should be the field of competition will eventually be determined by market forces. But this is also an area that regulators need to focus on to create a regulatory framework that continues to spur innovation. The Reserve Bank of India is deeply engaged in the process of technological transformation of the financial system. Its role has largely been to create an enabling environment for innovations to thrive by creating mechanisms such as the regulatory sandbox, hackathons, creation of fintech department within the Reserve Bank of India, and setting up our own innovation hub. Recently, the Innovation Hub and Reserve Bank developed and announced a public tech platform for frictionless credit, which is another example of how financial infrastructure is either created or promoted by Reserve Bank of India or other public authorities. The platform is being developed by the Innovation Hub to enable delivery of frictionless credit by facilitating seamless flow of required digital information from multiple sources to the bank. The platform will serve as a public good and exemplifies RBI's approach to fostering innovation. This is the fundamental role that RBI plays. At the same time, RBI also plays the role of regulating the evolving financial system to maintain financial stability. Rapid technological changes can outpace regulatory frameworks and raise issues about market integrity, consumer protection, data privacy, and fair market practices. The agility of new age fintech firms can challenge traditional regulatory models as well, making it difficult to ensure compliance at all times and maintain stability. The reliance on digital platforms also amplifies vulnerabilities to cyber threats and data breaches. As fintechs amass sensitive financial data, ensuring robust cybersecurity measures and maintaining data privacy becomes paramount to safeguarding consumer information and financial systems. The rush to roll out new products and services could potentially undermine market integrity and compromise customer protection. Therefore, while fintech innovation holds immense promise, a balanced evolution where innovation is responsible and inclusive is essential for the sustained positive impact of fintechs on financial services. The regulations for P2P in 2017, the guidelines for account aggregators in 2016 are examples of RBI's proactive developmental role. As is the introduction of two-factor authentication way back in, I think 2012. The focus of the digital lending guidelines, more recent digital lending guidelines, on fair treatment of customers demonstrates the prioritization of innovation with suitable guardrails. It is important to recognize that regulation plays a crucial role in managing the pace of change and allows the financial system to adapt to new innovations without threatening the stability of the system. Self-regulation. This is probably the way to go about, at least in the initial stages. I have mentioned that before. Fintech entities are not strictly financial entities, so the regulation approaches and the models of regulation that currently exist may not really apply in their entirety for fintech firms. So regulators as well as fintech firms are learning to evolve this arrangement, where regulators need to know what needs to be regulated, to what extent it needs to be regulated, and fintech firms need to know what are the priorities of regulation and how do I ensure that the products I develop will remain compliant as we go forward. I think the best solution for that, at least to begin with, is self-regulation. As regulators continue to contemplate, implement, and refine regulations for the orderly development of the fintech sector, self-regulatory organizations, or SROs, could play a pivotal role in the fintech industry by promoting responsible practices and maintaining ethical standards. These industry-led bodies establish guidelines and codes of conduct that foster transparency, fair competition, and consumer protection. SROs can facilitate collaboration between fintech firms, regulators, and stakeholders, creating a framework for innovation with guardrails. By proactively addressing issues like market integrity, conduct, data privacy, cybersecurity, and risk management, SROs help build trust among consumers, investors, and regulators. Their voluntary compliance mechanisms contribute to a more sustainable and reputable fintech ecosystem, ensuring growth while minimizing potential risks and negative outcomes. In the context of a new and evolving sector like fintech, it is the industry participants who possess the deepest understanding of the processes and practices within the trade. Therefore, they are best suited to establish common rules, enforce them, and effectively handle disputes that may arise from non-compliance with these rules. To conclude, I think it is important for us to recognize that it is crucial for fintechs to continue collaborating and innovating to enhance the effectiveness of the financial sector. Collaborating and competing with fintechs is essential for traditional financial entities too, in order to adapt. While innovation is vital, it should also support social and economic goals. Regulation should play the role of guiding the sector to those goals. Self-regulation needs to play a far more active role too. Together, industry participants, fintechs and banks alike, regulators and SROs can work harmoniously to shape a vibrant and resilient financial landscape that promotes inclusivity and progress for all. Thank you for your attention and wish you all the best.